Good day and good evening, and welcome to this webinar, which is part of our East Capital Group Outlook series, today on China. And my name is Karine Hirn. I'm a Chief Sustainability Officer of East Capital Group based in Hong Kong. And for today's webinar, I'm delighted to share the floor with my colleagues Dmitriy Vlasov and Zhang. So we're going to try to find out what is in the books for China in the coming year. 2023 was a difficult year for China equity investors. I think we have been investing in China for now soon 14 years, and it was definitely one of the more challenging years. China had a real estate crisis, weak consumer sentiment following a disappointing maybe recovery after the removal of relaxations after the COVID period, and also, of course, a lot of issues related to indebted local governments. What is interesting, though, to discuss today is what our thoughts are as we are on the ground. We visit companies, we travel around China, and that's why it's very important to discuss as well on the feedback we get from companies we invest in, and some views on sectors and the main topics. So I will start my first question with you, Dmitry. I mean, China key growth drivers for the last 3 or 4 decades are all very well known. It's been about property, infrastructure, and exports, and all these key growth drivers have faced headwinds recently. So looking forward, what do you see for China?
Well, indeed, it was a very challenging year for people like us investing in Chinese equities. And I think the year started on a very positive note. Following the abandoning of COVID zero policy, the markets went up, probably higher where they should be, and then they gradually started coming down and actually closed the year in deep negative territory. What was even worse, that most of the other markets, they actually had a pretty good year. So China yet again was an outlier in that sense, and obviously it's the second year in a row, at least for the onshore index, when we had negative returns. So not very encouraging for investors. But if we try to look at what exactly caused such a negative performance, so if you look at the chart, with the key economic data year to date, and it's mostly for the 11 month, because we still haven't got some of the data for the month of December. But you can see that not everything is bad, actually. Retail sales was up 7.2% year to date. So it's not as high as initially thought or was estimated by many analysts and strategists. But we should not forget that China, there's almost no inflation in China. So this 7.2%, it's much harder to get to compared to some other countries where you have a very high level of inflation. So, that's not bad. Industrial production was very strong during COVID years and continues to hold up very strong this year, 4.3%. So where we see weakness is in the fixed asset investment. And again, even there, it's not everything straightforward. So in infrastructure and manufacturing investments is actually doing relatively well. And we have real, weakness within the property sector, which is, very well flagged by media and by analysts. So property is a pain point for China economy this year. What I would like to highlight, though, that contribution of property has been coming down because of 2 very negative years. So before the peak property, before the COVID at the peak, property and property-related activities accounted for more than 30% of the China GDP. So now this figure is coming down, and we have numbers from Moody's saying that it's around 22%, most recent number. So it's quite big decline in property related impact to the GDP. So ex properties, the economy is actually doing rather well. And property has obviously impact not just on the fixed asset investment, because most of the Chinese households, wealthy households, they have exposure to properties, more than 70%, and property and property related sectors, they're also big in the retail sales mix. So there is a lot of impact, of the property-related decline on the Chinese economy. But even properties, we are doing, I would say quite well, and reaching the target GDP, above 5% this year.
Okay, I think we might have, if we have the time, to go back to a little bit this topic of the property sector, because obviously very interesting. But basically, as you said, Dmitry, it is a China which is transforming, and an economy where the growth drivers are definitely different. And we'll discuss that later as well. Now I want to change the topic a bit and ask how is views on geopolitics. Geopolitics have always been very strong impact on the sentiment of investors, and not only on the sentiment, obviously as well on investments. We've seen that actually recently with some numbers, such as the fact that basically China suffered now an outflow of foreign direct investment last year, and it was the first time since records began in 1979. So clearly a topic of interest. So how we just also had elections in Taiwan. Please let us know, share with us not your personal thoughts on this, but in what way if this is going to be shaping the discourse about geopolitics and the frictions between the US and China in the coming month and year.
Sure. Thank you, Karine. This is Hal, Assistant Portfolio Advisor at East Capital Asia. And then talking about Taiwan presidential election, which just happened in at the last Saturday, I would say the result is pretty much in line with the poll earlier, and then people's expectation. The ruling Democratic Progressive Party, or DPP, that many people see as anti-CCP or as fighter for democracy and then freedom, won the third consecutive term. However, compared to a sweeping win last time, DPP lost the legislative majority, getting only 51 seats out of 113 total. So that means going forward, very likely we're going to see a more balanced policies coming from the Taiwanese government. So when we think about the result, I would say, or non-consensus view on this is that we don't think cross-strait tensions would escalate much, or we don't think it to pull down the financial market in 2024. Reason being, both US and China have their own higher priority items on their agenda, at least in the year of 2024. At the politically or economically, we believe that China and US will prioritize some other things over Taiwan, and they don't want to escalate the current tensions to a much higher level. There might be some potential escalations, of course, ahead of the US election in the 2024, but overall, we don't worry so much about Taiwan in the short term. Yeah, that's all from my end.
That's good. I think it's worth remembering as well that 2024 is actually the year of elections. I think it's one of the highest number of elections around the world. It's like basically one every third adult in the world, or every fourth adult in the world will be invited to go to the votes. But clearly the Taiwan election was starting early in the year, was an important event that a lot of investors were following. So maybe good that it's behind us now and we can focus on other things, even though, as you said, how the next big date is, and prior to that is of course the US elections in November 2024. When we discuss about geopolitics, I was actually recently in Mumbai discussing on this topic at a forum. We said that there are of course implications in different sectors, and it depends as well how much you're depending, for instance, on critical input and imports of things that you need to produce stuff, for instance. But so I will actually now to go back to the more the level of discussion regarding investments on what we're seeing on the ground. which sectors we think are of interest for investors and which sectors we've decided to prioritize in our portfolio in terms of allocation. So let's discuss that. So which sectors are we more constructive about, and why? Maybe I start with you, Dmitry.
Yes, indeed. And, since now this year haven't been COVID restrictions, it's really great to start traveling again and seeing companies. So we have been on the ground quite extensively this year, visited, number of small and big cities, went to Shenzhen, which is a great place to visit companies there because you have the companies from the sectors that we prioritize. And as I was touching upon in the beginning of our conversation, export-related industries that are taking the space left by the property, utilizing advanced manufacturing capabilities of Chinese companies, actually of primary interest to us. And Shenzhen is ripe, with this type of companies. We were visiting, BYD, and I just wanted to highlight
a slide,
yeah,
on BYD. Yeah, so 2 slides actually.
Indeed.
Yeah. Thanks.
And obviously, recently this company has been in the news because in the fourth quarter they overtook Tesla in terms of shipments of battery-powered vehicles. So BYD produced more than 3 million new energy vehicles this year, so much bigger than Tesla's 1.8 million. But they're also producing plug-in hybrids, which in China they're classified as new energy vehicles, but they're not purely battery energy powered energy vehicles. So anyhow. And we like this sector. Auto industry has been doing relatively well in China this year, even though consumption recovery was weaker and the confidence is not as strong as we wish it to be. But the overall sales in China for the autos were up, more than 10%. In large part driven by very strong performance of the NEVs, which is now around 9 million of produced cars in China, the EV or new energy vehicles. So really a good part of the auto sector, and the BYD is the largest player there. As I said, they are more than 30% market share. And now it's getting international recognition because their export is actually ramping up quite aggressively. This year they're expecting to sell maybe more than 400,000 cars on the export, which would be a big jump from the current year for the BYD. And actually, export of the autos is something really interesting within China equity space, because now China overtook Japan this year to become the largest exporter of the autos in the world, obviously driven a lot by the EVs export. And you can see here the BYD is benefiting from this trend, and they are still growing quite aggressively this year. They expect it to increase maybe another 30%, I would say. And in China, the penetration of the EV vehicles now reached more than 40%. So, and it will increase even further this year. So it's a good company. And if you look at the financial characteristics, you clearly see that it's what we believe is quite it's undervalued because the multiple is quite low and the growth parameters are quite robust, and then it's a market leading position both in China and hopefully when it goes global. So and when we visited the factory, we found a lot of confirmation to our investment thesis there.
Yeah, Dmitry, it's a very exciting company. I also visited it recently. We're also leading an engagement with this company on a number of topics related to environmental and social and governance factors, which is very interesting. But as you said, BYD is actually becoming a bit of a mainstream name, but we have it in a number of our funds, and it's pretty good to see. Now I'm going to ask Hao to talk about another sector and mention another company, which probably is not a company that anybody has heard about. Please, Hao.
Sure, thank you. So as Dmitry mentioned, we like in general the Chinese solution providers or exporters to the unmet global demand in certain areas. One more example here is the electric aerial work platform producer, which we visited recently as well. It's called Zhejiang Dingli, and you can see the pictures of us and then the boom lift here. If we go to the second page, we have some more details about the company. Basically, the company have 95% of the products as electric powered, and then they sell overnight around 70% of their products globally to ex-China regions, including US, Europe, and rest of the world, around same proportion. Financially, the company has a return on equity at above 20% constantly over the years. And we have been seeing the gross margins of the company coming back to 40% level from COVID impact, and net profit margin return back to around 25 to 30%. So we think it's one of the highest numbers we can get from industrial producers in China. And because I look at Korean markets as well, so when I compare to Korean industrial players, which have around 0 to 3% net profit margin, I always get really excited about how the Chinese companies can do. Yeah, that's one of our topics that we really like.
That's very good. I remember how excited you were about this company after visiting them, and it's a bit of a kind of gems that we like to find in China, going to a city where most people never heard about, and find that kind of companies and that kind of quality in terms of innovation and in terms of commercial strategy as well. It's very, very impressive. So, I mean, reflecting on the past year, I started the webinar saying that unfortunately it's not actually a year you want to remember too much about, but still we need to learn from what happened. So I'm thinking about, I would like you to elaborate a bit more on, like, when you reflect on 2023, there are obviously reasons to be gloomy, but also now could be the time to be contrarian. So my question to you, and we'll try to conclude on this webinar on that, is under which conditions do you think that things could go right for the Chinese market? Who wants to start?
I can start. I can start very briefly. I think there is a number of conditions that can go right. I think have a quite high probability that they will go right, and this would help investors generate some decent returns. But if we start, obviously, stabilization of the property market, that still remains the key variable here. And the government is doing a lot to actually stabilize the market. So they are launching this big program. It's called Urban Village Renovation Program. So essentially, they're targeting tier 1 and tier 2 cities, and there's some kind of village in the urban location, in the good locations, and they want to renovate those. So it's something similar what happened in 2015 when they had shantytown renovation. Essentially, that program helped the property market rebound, but obviously the scale of this is much smaller. And the impact mostly it's the 21 mega projects in tier 1 and tier 2 cities, and tier 1 and tier 2 cities actually been impacted by this property downturn much more compared to the tier 3 and 4. So if this program works, and we think it has a good chip because they have financing, they have some parameters, so that can help stabilize the market and digest the inventory. Then we shouldn't forget social housing. They're still kind of ramping up. 35 cities again. That doesn't produce new housing sales and activity, but it digests the inventory, which is the big problem. Once the inventory is digested, the confidence may return, and then obviously the buyers would move because right now we have still have situation with the excess savings, more than 5 trillion kind of on the bank accounts in excess saving. People are not spending, and the confidence, I think it's the issue. But just to be very brief here, the other factors that could lead to potential rebound, it's obviously the exit from the disinflation, because we have this deflationary environment. So yeah, they need to get a bit price rising, a better communication within different government agencies, because regulation was one of the major impacts a couple of years ago. And lastly, it's the valuation and positioning. On this chart, you can see the valuation of onshore and offshore indices clearly there at the bottom of the range, whereas most of the other markets. Yeah, they're at the top. I would say elevated risk premium against the background when we have historical or close to historical low interest rates, 2.5% on 10-year yields. So I guess, and then the position, it's very, very bearish in terms of global funds and all these things. They can reverse very quickly what happened in the beginning of this year, but hopefully in much more sustainable fashion this time.
How did you have, we are running a bit short of time, but do you have anything else to add on your side in terms of what do you think the government might focus efforts in order to revive the economy and create a more positive environment for investors?
I think Dmitry actually covered everything that's important for the Chinese markets. Basically, we just need more and continuous support from the government to actually boost investor sentiment and then economic recovery. So we need the actual turning around of the economy in terms of the numbers such as GDP, PMI, CPI, PPI, etc., for people to really think carefully that they will come back to a growing or recovering Chinese markets. But I agree with what Dmitry just mentioned.
Great. So yeah, so basically, as we said today, we might be around the corner soon, or maybe we've already gone. Like maybe the worst is behind us. We have potentially a slightly more positive geopolitics, even though we should be aware that we will keep having probably some tensions in the period. And what is more interesting and maybe more exciting is that even in an economy which doesn't grow as fast as it used to, you can find very exciting pockets of growth, be in these new industries where you have very innovative companies. And of course, we as an active stock picker, we can choose which companies to invest into. And we do have a number of very exciting topics in our portfolios. So on this note, I want to say thank you to Hao and Dmitry for joining me today. Thank you for our investors who called in. If you have any specific questions, please let us know. Talk to your investor relation person at this capital group, and we'd be happy as well to organize any specific one-on-one with any of our colleagues. And the next webinar in this Global Outlook series will take place on Thursday. It's about global emerging markets, and obviously we will also be talking on China, but not only on China. There are a number of other markets we will be discussing. On this note, again, thank you so much and have a great day, a great evening. Bye-bye.